The current gold market represents a structural re-rating of the asset class rather than a temporary sentiment-driven rally. This shift is powered by a three-piston engine. Piston 1 is central bank accumulation, a strategic de-dollarization effort where sovereign entities led by China are ramping up net imports to hedge against dollar-denominated financial systems. Piston 2 is the real yield mechanism. As fiscal deficits increase and the Federal Reserve eventually eases, the opportunity cost of holding non-yielding bullion drops, mechanically increasing its appeal. Piston 3 is the retail and ETF flywheel, where institutional and retail buyers have shifted from tactical trading to structural allocation, providing record dollar volume support even during price corrections. Investing in this environment requires a rigorous four-part elimination protocol to separate undisciplined operators from compounding assets. First is all-in sustaining cost discipline. In a market where gold exceeds $4,500, a company with an AISC near $1,000 captures a $3,500 margin, whereas high-cost operators at $1,900 are significantly less efficient. Second is balance sheet architecture, focusing on firms in a net cash position that can fund buybacks rather than debt service. Third is jurisdictional quality. Assets in stable regions like Nevada or Western Australia carry lower risk premiums than those in emerging markets subject to royalty hikes or expropriation. Fourth is capital return discipline, rewarding management teams that prioritize dividends and reinvestment over speculative empire building. This filtering identifies 5 structural winners: a scale anchor, a quality operator, an optionality play, and 2 asset-light royalty businesses.
Newmont Corporation functions as the scale anchor, providing a moat through massive industrial diversification across the Americas, Australia, and Africa. Producing 5.3 million ounces annually, it operates with an AISC of $1,029, aided by copper and silver byproduct credits. Its fortress balance sheet features $8.8 billion in cash and a $12 billion cumulative buyback capacity. However, its scale limits rapid production growth, and sovereign risks such as Ghana's royalty adjustments remain a headwind. Agnico Eagle Mines offers a moat based on geography, concentrating assets in Canada and Finland to secure a rare A- credit rating. While its AISC is higher at $1,483, it offers the highest level of jurisdictional safety. The primary risks for Agnico are energy cost inflation and a production profile weighted toward the latter half of the year. Barrick Mining Corporation provides a unique hybrid optionality play, combining gold production with a significant copper growth vector. The Nevada Gold Mines joint venture remains its low-risk core, while the Lumwana expansion in Zambia positions the firm for the electrification supercycle. Barrick's financial transformation is notable, swinging from net debt to a $2.41 billion net cash position in 1 year. While the company offers high beta torque to both gold and copper, this diversification means a copper drawdown could weigh on the stock even if gold prices rise. Additionally, the planned spin-off of its North American assets into a standalone IPO introduces near-term corporate restructuring uncertainty that investors must monitor.
Wheaton Precious Metals and Franco-Nevada represent asset-light compounders that avoid the operational risks of mining. Wheaton utilizes a streaming model, paying upfront capital for the right to buy future production at deeply discounted prices. This generates an 85% gross margin, a figure typical of software companies, not resource firms. While Wheaton captures pure upside, it lacks operational control. It is a passenger to the performance of the mines it funds. Franco-Nevada serves as the defensive core, maintaining a zero-debt balance sheet and a diversified royalty book that includes energy assets. This energy exposure protects Franco-Nevada from the input cost inflation that hurts traditional miners. Its main risks are a persistent valuation premium and unresolved regulatory issues at specific assets like Cobre Panama. Portfolio architecture should follow a clear hierarchy. Newmont and Agnico Eagle are the core anchors, providing the foundation for scale and jurisdictional safety. Franco-Nevada acts as the defensive core for risk-averse allocators due to its lack of debt. Wheaton Precious Metals serves as a high-quality growth satellite, offering high-margin compounding at a premium valuation. Finally, Barrick acts as a high-beta tactical satellite for those seeking leveraged exposure to both gold and copper. This tiered approach allows investors to calibrate their exposure to operational and jurisdictional risk. The ultimate objective is to utilize these 5 winners to capture the structural re-rating of gold, treating $5,000 not as a speculative ceiling, but as a fundamental waypoint for the sector.